Going to take a look at some dips within this particular video on the silver log, and I was stating at around 40.70 that it's a little cautious to be buying when the market's up too much, or what is perceived to be a little bit up too much. And thus, when you're buying on dips, that might be an ideal time. But what is a dip? And it's obviously when the market retraces lower or has even a significant time correction. In this case, in here, it might have been seemed like a nice dip for $1 here, and in some cases that would be the case. But when the market moves from 42 down to 40, and you have a decent red candle, that's quite frankly a dip. And within this period, it's a decent sized range. So you're looking to get in on the bottom part of this, which is why this would be the first dip. Now this one in here, you know what? I don't even know about that. I drew it in there, but it was not that big of a dip going from here to here. So I don't know if I'd want to count that. The second one, or the next one, excuse me, would be definitely counted. When you go from this area of 43 down to 42, that's about half a or 5%, a half of 10 is what I was trying to think of. Therefore, it was a dip, but there wasn't much time to get involved in it. And here again, not much time for this one. Even less time on this one. There hasn't been too many buying opportunities. And within this dip here, I've added a few blue lines because we're still within a dip for this move lower. And there's two blue ones which indicates dips within the dip. Because you're down, you're looking to possibly move intermediate term lower or just switch the trend to a bear market. And if that's the case, obviously every time you start to go higher, you're eventually going to sell off. Now, another way of playing when you get within the dips is you move it until you break a resistance point to a certain barrier. When you're in a bull market, that is. When you're in a bull market, you find where your support level is, which is what needs to hold, which is this level in here, which keeps you in the buying mode until you have a significant breakout above the line. Therefore, let's assume that that's what the strategy was. You find the dip in here, and let's assume that that's right in here. And that's an area where you may sell, or you generally speaking, you sell, or at least stop buying for that matter. And you enter this range. Well, you had an opportunity to obviously buy for cheaper than you sold in here. And you want a confirmation breakout. Obviously, this is in here. Now it's up too much here, or say that just say assume that to be the level. Once again, only a very quick opportunity in here, and then it's obviously just kept rolling towards the upside. And a lot of situations where you just let the gains come in, and if you end up selling in any of these places, well, sometimes you'll be right, and obviously sometimes you'll be wrong. Now, a lot of this trading here is if you're trying to find the best possible price at AppMex or SpotMex or any place that can help you get a lower price, even if you're able to barter with cheaper prices. Myself, I was able to state, okay, so now we've seen silver retrace this much lower. It's a little bit easier for me to barter with a coin dealer here than it is in here because the price is lower. If he is very firm on his prices in here, then either he'll be or she will be less firm in there, or they'll just naturally lower the price, and then obviously you get your dip that way. That's one of the directions in which you would be doing it. So if you're trying to buy bullion every so often, you look for these little opportunities to buy. If you're playing the dips, these are where you would be looking towards getting into, because you'd be buying it in here even at 48. When you go from 50 to 48, that's when you would be starting to buy again. When you bought at 48, you bought at a top. or close to it, because we haven't seen 48 since you would have last bought right in here. And then you bought in here, you buy in here, and well, this is, you see with the blue line, as it moves down to 46, the market goes higher. So here, like, eek, you know what? Don't want to, because it's up a little bit. If it goes back lower here, yes, maybe confirms some sort of breakout, then I'll decide to go. Yeah, there's another play. And then you enter back within the range, yeah, go a little bit more, and now it breaks support, so you don't even have that blue line because you need to go lower to start your dip. So whether it happened in here, and sometimes the dip might be where it's shorts. You might say to yourself, well, if it goes to 44.01 or 44 even, I'm going to buy. If the bottom's at 44.05, you missed it, obviously. And same thing, you start to rally. Okay, do you want to see how it settles in and see if it can break out before any strength buying? This is the for the shorter term. Now I have this also on a longer term level. And let's look back at what happened before. You have a buying dip in here. You can buy on strength on a breakout, but it really never gave us gave them a buying opportunity till in here. And it stayed within this range for quite some time. And if you're playing to go on the breakout, you either stop buying here, and if you're playing on the dips, you might even stop buying in here. And there was not one single dip along the way until this blue one here. And this blue one represents one gigantic dip. When you're in a situation where the market just crushes you when you buy this way, if you want to continue, you have to assess, is this worth doing? Am I in the right trend? Now, the only reason, I can't say the only reason, the biggest reason I would be, and at this point am, in within this trend is because of a word called inflation. It's the lock, if you will, for long-term gains. And when we see this long-term dip, you say to yourself, well, obviously it was this big here. It's got to get higher again. It must, doesn't it? And if inflation is true, and we have this extra money supply, and if inflation is true, and we've seen products rise since the 1970s, then it seems likely that it probably will. And for the most part, if you're within this blue range, it really shouldn't matter where you buy it, because if it's going to go higher, it doesn't matter at all. Just obviously, if you want to get the better prices, then you can use whatever strategies. But the red lines indicate when markets get overbought. Because you're in a bear market, you don't expect to make higher highs, you expect to make lower highs. And you did make this lower high, and you expected it, and that's why at some point you state, okay, it's now up too much. Same thing in here, up too much, gets up too much in here, and you're in a little bit of a range for this market, a little bit of a range. And until you break it, then once again, the market states that there's no need to say you're in an oversold, overbought condition until you go higher. And in this case here, it might have hit at the very top. It's kind of close because you can see it just barely broke this resistance line. Once again, I don't know if this one would count as an overbought. But within this, when you're reaching a resistance level you haven't seen in quite some time, and then you really confirm a breakout with this higher low, there's no reason not to buy in here. And then you make this gate in here, so at some point you're overbought again. And then you start to have this dip. You see this red candle. There's your dip from here to here. The market goes from like 15 down to like 10. That's a pretty decent sized correction. And then you get a little overextended, making new highs in here, and it didn't last long. So you have a big fall, obviously major buying opportunity. And when the market comes back to its previous levels, you got to state, okay, now are we in overbought conditions? I have it set from its previous range. And in hindsight, and even in math theory, you could state, well, maybe you should have said it was a little overbought here. And for the most part, you could be right. But using the theory of new highs, you have this previous high. You got to break it by a little bit. Whether you started here or started here, it's regardless, but it's pretty much been a decent size of an overbought condition within this methodology. But as we know, overbought doesn't mean it can't continue to become overbought. However, if you were looking to buy when you were not within the red lines, that's the rule you place. As long as it's not within this red line, I buy. Then the methodology right now says you're not buying. You need to see a correction on this chart to buy. For the most part, you were buying back in here, which is why if you need to build a core position, then trade within this blue line, which means buy anywhere. If you're trying to add more, you're trying to time better prices, then you really need to wait for that correction. And when you have these type of moves, it literally gets to the point where, say if it's in here in the anyway, you break this level here. You haven't bought since say you bought your last at say 10, and you're waiting for a correction because it's up way too much from here, and you don't get it until in here. And from 50, you got to think 25, 28 is a decent sized correction. So you're waiting to buy at a lower price when it was at like 11, and you get that lower price at 25. That can be the scenario. Now, not every single time you have a major move like this, you're going to crash and then crash more. But most likely, every single time you make a move like you did before in the 70s, you're going to crash. Whether the crash will hold as the bottom, well, market indicators and time, of course, will have to determine that. Thank you for watching this, and take care. Bye-bye.